What if the very life insurance policy meant to protect your family ends up creating a major estate tax problem? In 2026, that remains a reality many high-net-worth families in North Carolina overlook. Life insurance is often viewed as simple financial protection, but under federal estate tax law, if you own the policy when you die, the death benefit may be included in your taxable estate. While North Carolina no longer imposes a state estate tax, the federal estate tax still applies. In 2026, the federal estate tax exemption is approximately $15 million per person, or about $30 million for married couples under current law. For families above or even approaching those thresholds, proper planning can be essential. One of the most effective tools for addressing this issue is an irrevocable life insurance trust, commonly known as an ILIT. An ILIT is a trust that owns your life insurance policy instead of you. That simple shift can dramatically change how the death benefit is treated. When properly structured, the insurance proceeds are paid directly to the trust rather than your estate, allowing them to generally avoid probate and remain outside the federal taxable estate because you no longer legally own the policy. Without this structure, a large life insurance policy combined with other assets could unintentionally push an estate above the federal estate tax threshold. ILITs remain highly relevant in 2026 because many estates are made up of illiquid assets such as real estate, family businesses, farms, and retirement accounts. When estate costs arise, heirs may be forced to sell those assets quickly or under unfavorable conditions. An ILIT can provide immediate liquidity at death, helping families preserve valuable assets and meet financial obligations without unnecessary disruption. It can also support fairness planning in blended families. For example, one child may inherit a family business while other heirs receive equivalent value through life insurance proceeds held inside the trust. The process begins with establishing an irrevocable trust under North Carolina law. A trustee, someone other than the insured, is appointed to manage the trust. The trust can either purchase a new life insurance policy or receive funds to pay premiums on an existing policy. However, timing is important. If an existing policy is transferred into an ILIT and the insured dies within 3 years, the IRS may pull the death benefit back into the taxable estate under the 3-year rule. For that reason, many estate planners prefer having the ILIT purchase the policy from the outset. Each year, the insured typically gifts funds to the trust to cover premium payments. Beneficiaries receive temporary withdrawal rights through what are known as crummy notices, allowing those gifts to qualify for the annual gift tax exclusion. Upon the insured's death, the proceeds flow directly into the trust, generally avoiding both probate and estate taxation. Like any advanced planning strategy, ILITs must be implemented carefully. One common mistake is failing to properly document crummy notices, which can create challenges with the IRS regarding gift tax treatment. Another concern is the transfer for value rule, which can cause portions of a life insurance payout to become taxable if a policy is transferred improperly. Trustee selection is also critical. Under North Carolina's Uniform Trust Code, trustees have a duty to act prudently, maintain records, and manage trust assets responsibly. Many families choose professional trustees to help reduce risk and ensure compliance. An ILIT can also provide meaningful creditor protection. In North Carolina, life insurance proceeds paid to a trust are generally better protected from creditors than proceeds paid directly into an estate. This protection can be especially valuable for blended families, business owners, and individuals in professions with higher liability exposure. Although ILITs are irrevocable, they are not necessarily inflexible forever. North Carolina law permits certain trust modifications through a process known as decanting, which can help update outdated trust provisions when circumstances change. Families may also combine ILITs with other advanced planning strategies, such as spousal lifetime access trusts or Section 1035 policy exchanges, provided they are carefully structured to avoid unintended tax consequences. The real takeaway in 2026 is that an ILIT is much more than a tax strategy. It is a liquidity strategy, a protection strategy, and a legacy strategy all in one. It helps ensure that life insurance fulfills its intended purpose, protecting loved ones without creating unnecessary tax burdens or forcing the sale of important family assets. Because ultimately, the goal is not simply to leave wealth behind. It is to ensure that your family receives that wealth intact, protected, and according to your wishes. So the real question is this: if your life insurance paid out tomorrow, would it protect your legacy or complicate it?